We now turn our attention to economic data out of the U.S. Slowing economic activity and easing inflation points to the Federal Reserve on track to cut rates at least once before the end of the year. Data show downgrades to consumer spending and a key indicator of inflation ticking down. The U.S. economy expanded more slowly than what it was estimated for the March quarter. The Commerce Department reported that the GDP grew at a 1.3% annualized rate from January through March. And that is down from the advance estimate of 1.6% and notably slower than the 3.4% pace in the final 3 months of 2023. Meanwhile, a gauge of existing home sales tumbled to a 4-year low in April. This comes as higher mortgage rates cast a pall on the spring selling season. Mortgage rates in the U.S. rose for the first time in 4 weeks. Borrowing costs have been hovering around 7% for weeks. Prices remain high and inventory is still tight by historical standards. The easing in GDP indicates that the Fed's goal of progressively cooling the economy through high rates is having an effect. This comes as consumers increasingly fear increased costs. However, it is not clear if the weakening trend in inflation will continue or not. Investors will eye the release of the Fed's favorite inflation gauge on Friday for further cues on rate path.